Hey there, welcome back to Inside. I'm Rachel Berry, and joining me now is Caleb and Heather from Foster Financial, and we're so excited because we're chatting about something that's quite important, a topic that needs to be talked about more.
Yes.
So what are we chatting about today?
So how interest rates affect your pension. So I really like to we've talked about this actually recently on the show, but I wanted to do this again because we really need to get a call of action out there to people.
Okay.
Because interest rates will greatly affect people's lump sum payouts. So this is for the lump sum people. So I just want to give you an example because this example will help people understand. If you were to buy a mortgage, let's say a year ago, and interest rates were 3%, which was the case, and you said, hey, I need my monthly payment to be right at, say, $3,000 a month.
Okay.
And it's 3% interest at $3,000 equals basically about a $700,000 mortgage. You can buy a $700,000 house and you're like, woohoo, I like that, right? Nice house, get to go shopping.
Nice.
But today, the interest rates have gone up. So let's give an example of you want your payments to still be $3,000 because that's what's in your budget, but because interest rates have gone up to 5%, you now can only buy a $550,000 house. So you were able to buy a $700,000, but now it's only $550,000. You're going, that's still a nice house. Don't get me wrong in this example. But that is how the pension lump sums work. When interest rates go up, the liabilities of the companies go down, meaning the liabilities that they owe you, the consumer, you as the person, they owe you less because interest rates went up, so the lump sums go down. So a year ago, you may have been able to get a lump sum option of $700,000, and now it's $500,000. So we're seeing the rates go down about 20%. So whatever number lump sum you thought you were going to get, it might go down 20% or more as we see the interest rates continue to go up. Those lump sum payments are going to go down. So the call to action is, if you've ever gotten a quote or you've never gotten a quote, now is the time to do it because they typically recalculate the payments every October, November, every year, and it'll change your lump sum starting next year.
Why is this important to know? Well, you kind of mentioned it, but why is it important to know right now? Because like you said, we are calling everyone to action here.
If they wait, let's say they wait to January, their payments could have gone down by 20%. So think about somebody again with a $500,000 lump sum payout. That can go down by $100,000 in a matter of a couple months. So make sure you run those, make sure you're looking at it. And then Caleb's going to talk about some pros and cons about the lump sums because not everyone has the lump sum, but those that do need to consider some things.
Yeah, it's a great point. So, I mean, with the lump sum, really the pro for the lump sum is essentially that you get this massive lump sum of money. Let's say it's $500,000 right when you retire. The great thing about that is you get a lot of control with that. So you can work with your financial advisor. You could invest it in dividend-producing stocks, and you could kind of live off the harvest of that. The con is really, that's your set lump sum of money. So if you get really spend happy and you kind of go through everything, then that's all you get. And so what we typically compare that to is the single life payout, which with that, instead of the $500,000, you get $30,000 every year for the rest of your life. The risk there is kind of inflation risk. So $30,000 now is much different than $30,000 in the future.
That's really interesting. I think it's also interesting that it continues to change. So from last year to this year to right now, it has changed drastically. And is that what you've seen?
Yes, I mean, it is what it is. I mean, some places actually recalculate these lump sums quarterly. Most big, large plans calculate them. So they're going to pull the new numbers in October and November based on current interest rates. They will change those lump sum payments starting next year. So the call to action is if you don't go out there and get a quote and see what it's going to be this year and see what it's going to be next year, you may not be aware that there's $100,000 or $150,000 difference. That's real money. So you need to get a pension quote. You need to find out from your company, are you guys changing rates? Because they will, because pensions are based on life expectancy, the current present value of money, which that is tied to interest rates. So when they go up, corporate rates on corporate bonds go up, we know for sure the lump sums are going to go down. It is a part of the calculation. So your lump sum payments are going down. You need to make sure if you were on the fence of potentially retiring, you might want to pull that trigger a few months early because it can be a huge difference in payment.
Well, thank you guys so much for being here. Once again, it's all things that we all need to know every single day. So yes, I appreciate you guys so much for being here. And if you have any financial questions, call the number on your screen for a complimentary consultation today.